employment there was basically flat last month. We are seeing some evidence here of decay in the labor market. Today's jobs report was even weaker than the headline. And even when they were printing super strong several months ago, and everybody's talking incessantly about the red hot labor market, the numbers have been grossly inflated. They are going to be revised down dramatically in the future.
The U.S. labor market has been closely watched for signs of a slowdown as borrowing costs hover at two-decade highs. An economic consultant who accurately called the 2008 recession has again claimed he is skeptical of the U.S. economy and says a course correction is on the way. David Rosenburg, the founder of Rosenburg Research, made the declaration Friday, hours after April's jobs report fell short of expectations. U.S. job growth slowed more than expected in April, and the increase in annual wages fell below 4.0% for the first time in nearly 3 years. But it is probably too early to expect that the Federal Reserve will start cutting interest rates before September, as the labor market remains relatively tight. On Friday, the Bureau of Labor Statistics reported the latest monthly payroll data for the U.S. economy. Total employment rose by 175,000 in April. The unemployment rate rose slightly to 3.9% from 3.8% in March. That came in below estimates of 240,000 jobs for April. David voices his criticism of the Bureau of Labor Statistics, BLS methodology, mainly targeting the birth-death model. This model includes an estimation of net new business creation in the survey data. Moreover, according to David, the recent jobs report was even weaker than the headline figure of 175,000 implied. The latest data paint a softer picture of U.S. employment trends, good news both for Federal Reserve officials worried about inflation and those with fears that the economy has been running too hot. Despite fears of an economic downturn, the unexpectedly resilient job market, fueling consumer spending and overall economic growth, has sparked optimism that the U.S. may sidestep the historically associated pain of heightened borrowing costs. According to David, there's been nonstop chatter about the sizzling labor market, but he believes the numbers are significantly inflated and anticipates they will undergo substantial downward revisions in the future. Now let's break down what this all means, of course, with David Rosenburg, an economist well known for his thorough and forward-looking analysis.
This jobs report was even weaker than the headline suggested. So 175,000 on the headline, but what wasn't mentioned was that the work week contracted by 0.3%, back to 34.3 hours. So if you're taking a look at bodies and hours, and you're taking a look at total labor input, which is the index of aggregate hours worked, it was negative 0.1. So when you combine how much time people spent working, in addition to, say, that 175,000 headline, if you actually believe that number, and of course it'll be revised, it's as if the economy lost 160,000 jobs last month when you count in the contraction of the work week. The other point that we have to consider is that this BLS, I take out the L out of the BLS when I look at these numbers, and we'll just call it BS. Half of that number today was the birth-death model. So don't forget that the Bureau of Labor Statistics, they have their survey of their existing sample of 700,000 establishments. But then they add a skew to the number called the birth-death model. And we're not talking about obstetricians here. We're talking about that they do an additional estimate based on net new business creation. Well, half the number today came from that birth-death model, their guesswork on other employment being created by some model that they have on net new business creation, which boggles the mind because in real time, we could see from the data that on a year-over-year basis, the number of business insolvencies, for all the people that say, well, there's no recession coming, business insolvencies are up 35% year-over-year, and gross business startups, business formation is down 5%. And the model is the model. It's the BLS model that actually half that 175 was outside the survey. It was in the birth-death model, which I think is flawed. And there's one thing nobody's talking about, but I've been slamming my fist on the table since last week when we got the data from the QCEW. What's that acronym for? The Quarterly Census of Employment and Wages. That isn't a sample. That's everything. That's 12 million entities. And it showed that, and the data, because it's everything, and it's census data, so it goes to last year's third quarter. But it shows that these payroll numbers, and I'm amazed at traders putting down so much money trading around these numbers that are going to get revised, but are not giving an accurate portrayal of what's happening in the labor market, partly because post-COVID, the response rates have been so low. And of course, we have really what's a crazy ongoing net addition to the numbers from the birth-death model, which I continue to have to explain to people. That is not a real number. That's an estimate. But the QCEW, the census numbers, are showing that these non-farm payrolls, that everybody has got their nose to the screen at 8:30 in the morning on on-farm Friday, that data is overstating employment by between 800,000 and 1 million at an annual rate. In other words, 70 to 80,000 are being skewed. And what's that delta from? From the birth-death model. So that's what's happening here, is that the data, and even when they were printing super strong several months ago, and everybody's talking incessantly about the red-hot labor market, the numbers have been grossly inflated. They are going to be revised down dramatically in the future.
The job market's resilience is surprising, but cracks are starting to appear. Fed officials are watching labor trends as they contemplate when to cut rates. But different measures are telling different stories. Signs of labor market cooling raised optimism that the U.S. central bank could, after all, engineer a soft landing for the economy, and doused chatter of stagflation, which had been fanned by news of a sharp moderation in economic growth and a surge in inflation in the first quarter. Financial markets boosted the odds of a September rate cut and saw the Fed reducing borrowing costs twice this year instead of only once before the data. David warned that if non-farm payrolls turn negative in the next few months, there's a severe risk that the Fed will pivot to rate cuts. Let's shift our focus to a video.
If the labor market unexpectedly weakens, they will cut rates irrespective of what the lagging inflation indicator is telling them. He came out and he said that. Now, keep in mind, well, look, we saw the JOLTS data. The firing rate is dormant. Jobs claims, they don't seem to move much above 200,000. We're starting to get, and remember the downward revisions that we got today, we're starting to get a discernible slowing in the pace of overall job creations, which is hiring minus firing. Well, you do know from the data that the hiring rate is coming down hard. But the reason why you're not seeing actual contraction on payrolls is because companies are still hoarding labor. They're not firing. So what does the contraction in the work week tell us in the context of coming off a flat productivity performance after last year's miracle recovery? Is companies have overhired, and now they're responding by cutting the hours. But you see, the hours lead the bodies. Can you imagine what happens? Because we know for a fact what's happening with the hiring rate. The hiring rate is declining substantially. Imagine what happens if that bumps against an increase, which hasn't happened yet. But what if the firing rate starts to go up? Then what happens is you're not talking about plus 175 on payrolls anymore. You're talking about a big fat minus sign in front of these numbers. And are you going to tell me that we start seeing employment going down in the ballyhooed? There's a serious risk with no guarantee, a serious risk though, that in the next 3 months, non-farm payrolls is going to print negative. And nobody's going to remember all those questions about are you going to be hiking rates. They will be cutting rates at the very next meeting that follows a contraction in payrolls. That could be July or that could be in September. And we're seeing what's happening between the low post-COVID response rates, the veracity of the data is hugely in question. And that's why I couldn't understand what was happening at the Fed. Because back in December, the head of the Philadelphia Fed, Patrick Harker, came out in a speech and he said that we made a big mistake in 2021 in the 2022 because we were focused on the data and we believed in transitory, and businesses are telling us, like, around the country, all these business contacts are saying, no, actually, there's more endemic cost push inflation coming in than you realize. And he says we didn't listen to them. We should have focused more on the anecdotal evidence, the survey evidence, and what contacts are telling us, but we focused too much on the data, and the data inherently are lagging and contemporaneous, and that's what the Fed is focused on. So I thought in December, well, that's very interesting. The Fed is actually telling us that they're going to start to focus not so much on the data, but actually on what business contacts are telling them. And of course, at the very next meeting, what does Powell say at the podium? He starts talking about the venerable Fed Beige Book, which goes back 53 years. And, I read the Beige Book that shows you what I do for fun or how much time I spend in the tarmac. I read the Beige Book that comes out every 6 weeks, top to bottom, because it is the most comprehensive assessment of the U.S. economy across industry and across regions. And these are the Fed's own contacts giving them information that they write up. And I read the last one that came out, in the middle of April. And I read about what they said about employment, weak, retail sales weak, everything was basically weak. Even the stuff that was booming before, like leisure hospitality, that was actually seeing some erosion at the margin. This was actually, I wouldn't say it had recessionary thumbprints, but pretty well an economy flattened its back.
The U.S. economy likely added nearly 250,000 new jobs last month, extending the longest streak of sub-4% unemployment since the 1960s, as the labor market continues to defy repeated warnings of a slowdown and Federal Reserve interest rate hikes. One potential challenge? It's a very difficult moment to assess exactly what monthly labor market data are telling us. We value your thoughts, so feel free to share them in the comments.